want to welcome to our little talk today Don Yount with Southwest Mortgage and Peter Hernandez with Douglas Elliman, and we're going to see where this talk goes. And I'm Arthur Greenstein with the Arthur Greenstein Group at Douglas Elliman. One of the questions I asked earlier when we were just chit-chatting around the garage was, you know, the interest rates. The media is blowing everything, in my opinion, out of proportion, which is what they do best. And I don't feel that the current environment where the rates are super high or fluctuating really, really quickly is a bad thing. I think that there's strategies around that. And somebody told me that one of the strategies, and I don't know if it's right or wrong, maybe you can give me some insight from your perspective, was to go and get these short-term ARM loans that are very aggressive, and they have caps on how high they can go, and on the low part they also have kind of a floor, but you can always refinance if those rates get really better and getting into a home easier.
Yeah, you know, I think ARMs are especially when rates go up as quick as they've gone up, a lot of ARM products come out, and I think just looking into the ARM product, and when you talk about an ARM product that might not be a Fannie or a Freddie or a Ginnie product, it might be more of a actual bank product. That is the few times that you do need to actually read your note documents, or you actually you need to look at what the index is on. You need to make sure that there's no prepayment penalties. I think that's the big thing that, you know, 20 years ago that people were not expecting when they were doing the ARMs left and right, is they went to go refi it the following year and they had these huge prepayment penalties. So make sure that you don't have those. But there will be there is some ARM products that are coming out as rates stay high. There'll be more and more. I love a 525 or a 723. A lot of times you can get in at a lower rate, and you know the average person doesn't stay in a house but 5 to 7 or less time. So at that point, you're never looking at a change. You're never looking at a rate change or you know, a constant 6-month moving kind of a deal, mm-hmm. But you still get a better than market rate.
So can you tell me a little bit what's a 525 and what's a 723?
A 525 is basically simply that it's fixed for 5, it adjusts once and then moves for the final 25, or a fixed for 7 and then moves for the final 23. So what they're allowing you to do is the servicer is allowed to move it once, and there'll be some caps. There'll either be like a 2 or 6 or an index that it goes off of, that it can move. Now, sometimes when you're reading the fine print, sometimes that's not allowed to go down, or that it's only allowed to move this. So it is where you need a professional to kind of explain the ARMs to you a lot more than just a 30-year fixed or 15-year fixed. There's some more education is involved for sure.